thanks to Miami for giving me the opportunity to present the paper, to get feedback. We're still it's not a perfect paper, obviously, and we're still looking for ways to improvement. So suggestions are welcome. Okay, so let's get started. The paper is joint with Delphine Samuels, who's just moved to Chicago recently, myself, and my longtime colleague Robert E. Bracchia. And we'll see how things work out, but this may very well be his penultimate paper before he retires. So we may see. So this may have the last correct paper, which is kind of thing. Okay. So let's get started. The paper's on the economics of misreporting and the role of public scrutiny. So I want to start this with some motivation, all right? So this is a couple of news headlines. These are all headlines from various news organizations. They got me thinking about this particular problem. Is Elon Musk a fraud? Is Tesla Theranos? What's Tesla doing? They're manipulating their earnings. Why are they profitable? So there's certainly allegations out there that Tesla is sort of engaging in some sort of massive fraud. There's lots of CFO turnovers, lots of personnel issues. And so some people say, no, Tesla wouldn't be engaging in fraud because everybody's paying attention to them. So if they were engaging in fraud, the SEC would drop the hammer on them. It'd be very easy for the short sellers to detect it. And so no way is Tesla engaging in fraud. Right? So we're thinking about this a little bit more, and I thought, well, is that right? The fact that people are paying attention, does that make fraud more likely or less likely? So then I started reading the academic literature on where earnings management occurs, and the academic literature more or less says that earnings management tends to occur when people aren't looking, in opaque environments with less scrutiny, when nobody's paying attention, in footnotes, things are all sort of buried, nobody's paying attention. And so that logic would lead you to think that definitely Elon or Tesla is not conducting fraud. And I don't know where they are now, so no allegations are being made. But it's interesting when you think about that logic, it seems like compelling intuition. Fraud occurs when nobody's paying attention. But if no one's paying attention, then whatever the valuation statistics are don't really matter for prices. And if the valuation statistics don't matter for prices, then what's the compensation to the CEO from engaging in fraud, right? So if you're going to manipulate something on the financial statements or even a non-financial statistic, you would tend to do so if you derive personal benefit from manipulation, which means either your compensation is explicitly based on that statistic, or it's a value relevant factor in prices. So it's a little bit more complicated than just, hey, fraud occurs when no one's paying attention, because the story is if no one's paying attention, if the tree falls in the woods, no one's there to hear about it. So that was sort of the genesis of that's how we were thinking about things at the very beginning of this project. And so that led us to a few questions. How does the ex ante level of public scrutiny at the firm influence the manager's decision to misreport? So here we basically have in mind that the manager's doing a cost-benefit trade-off about whether to manipulate the financials or not. And it's a question of how public scrutiny affects that cost-benefit trade-off. Is it just coming through the cost side, like we talked about, where high scrutiny means higher probability of detection? Higher probability of detection means less likely to manipulate. Or is it only coming through the benefit side? Higher scrutiny means, driving value, more motive or opportunity to manipulate statistics. So based on this, we sort of formulate two channels, one of which we're going to call the monitoring channel. This is kind of based on what we would consider to be the conventional wisdom in the literature. And here the notion is that, high scrutiny, higher probability of detection, increasing the cost of misreporting, greater costs, less misreporting. relatively straightforward. If you know the SEC is going to be looking at you, you're less likely to be engaging in fraud. And this conventional wisdom, or this monitoring channel, is basically the predominant view in the academic literature. We see this in some of Luigi Zingales' work, some of Greg Miller's work. It's the genesis for this press as the watchdog, corporate governance role of the media, that sort of story, right? So there, misreporting is prevalent, but no one is watching. Yeah. The alternative that we're going to formalize is the valuation channel. And this is in the literature, but it's a very, very, very few papers. Fabrizio actually has one paper that we cite in ours that looks at valuation channel. And so here, the valuation channel is, well, if you have more public scrutiny, that's going to increase the price response to accounting information, or in this case, we're going to focus on manipulation of accounting information. So it's going to increase the price response to the manipulated statistic, or what we would call the earnings response coefficient. So a higher price response to manipulated statistic means greater benefit, right? So if you think about a high growth firm where no one values earnings, right, where it's mainly valued on revenues or clicks or something like that, then they don't get as much benefit from manipulating 1 penny of EPS. The greater the benefit to manipulating 1 penny of EPS, the greater will be the likelihood of misreporting, of manipulating EPS.
Apologies to interrupt. The audio is sort of robotic. Is there another mic or something?
Sure.
You could use maybe. Sorry.
It's all right.
Maybe try to speak directly to mic.
Hold on a second. Sure, give me a sec.
Apologies for the interruption, but.
Oh yeah, I see that. This is audio warning. Sorry about that. Ooh. All right. So back to the valuation channel. So here the notion is that the greater the earnings response coefficient, the greater is the benefit from misreporting, and consequently the greater is the misreporting. We have these two countervailing channels, monitoring and valuation, that we think are at work, or that lead to the manager's trade-offs when thinking about how public scrutiny. But we're going to try in the paper, we're going to model these formally, and then we're going to try and do some empirical tests that actually get at the channels separately and looks at their combined effect when the channels are operating simultaneously. Okay, so what I'll call one of the novel aspects of the paper that I find to be fascinating is that you get a unimodal relation. Now, to be honest with you, I did not know what the word unimodal meant before I started this paper. We were calling it inverse U-shape or humped shape, but humped shape doesn't go well in an academic paper. So my mathematical colleague, Professor Varacchia, informed me of the appropriate term, which is unimodal. So if you learn nothing else from this seminar, you can go sound intelligent by using the word unimodal to describe an inverse U-shape. All right. So this is what we're going to predict, what our model is going to predict actually looks like the shape of the relation between public scrutiny and misreporting. All right. So what does the unimodal formally mean? It means that there exists a threshold. All right. So a threshold below which the relation is positive and above which the relation is negative. So it doesn't actually have to be a U-shape. It could be a triangular shape. It just means monotonically increasing up to a threshold and then monotonically declining. So what that means is that the greatest scope of misreporting isn't going to be in Tesla, where there's a lot of public scrutiny, and it's also not going to be in a setting where no one is paying attention. It's going to be in the middle range, where you have just enough attention to incentivize the manipulation of a value-relevant statistic, but not enough attention that it's going to be very easy for the SEC or for the short sellers to sort of
And so this U-shape, inverse U-shape, that's really hard to intuit. We definitely didn't really intuit it before. And so this really speaks to, I think, the role of the mathematical model. We use the mathematical model to sort of formalize a framework and to seek to capture as basic expressions as we possibly can with as basic parsimonious setting as we possibly can. So again, we don't take models literally, okay? We're taking them, intuitively or for illustrative purposes, right? And we see this in the other related work, okay? So where papers have a little model at the front, and then they have some representationally faithful work at the end. Fabrizio's paper is a great example of this. All right. Okay, so what are we going to do? We're going to use the existing framework, Fisher and Verrecchia. Okay, so nothing new here. Okay, we're not breaking any theoretical ground. Earnings is noisy signal of value. Okay, so we have R is our reported earnings, V is value, bias, and noise. Okay, so if you could undo the bias and you could undo the noise, it's game over. You just price the firm at some multiple of earnings, and it's all done. Capital markets understand that the manager can bias earnings. We're going to give manager the choice of bias, and they price the market in expectations. So if the market knows that the CEO is going to bias by 5 cents, they can just discount the firm's share price by 5 cents. The managers are rational.
I apologize. I think there are again a little bit of audio issues. Can you try this? Can we, maybe disconnect, restart Zoom, and
Restart
then
Zoom?
connect again? Yeah. So we'll pause the recording. We'll give you a
Sure.
bit more time. Thank you.
Okay, so again, not seeking to break any new theoretical ground here. Everything is pretty much the same as what's been done in the past. We're going to take the model, and we've got this construct S, which we're going to introduce as public scrutiny, and then we're going to assume that the cost of bias is increasing in S, and that the investor's ability to anticipate their reporting strategy is also increasing. Audio.
Jen, you're on mute now. Okay.
No,
Better?
I think if it, yeah, for now.
No. All right.
Sorry all.
All right. Okay, so not breaking any theoretical ground. There are other related papers out there. Fabrizio's empirical paper in GAE takes Fisher and Verrecchia. It doesn't make any changes to Fisher and Verrecchia. Speculates about what might generate something like a U-shape. We talked about. What we're doing here is we're introducing scrutiny, and we're making the cost of bias a function of scrutiny through probability of detection, and the investor's ability to anticipate a function of scrutiny. Other papers add an audit committee to Fisher and Verrecchia. Fang et al. Link the cost of bias with the noise. Right? So here they're going to link basically the noise to the cost of bias. And those are all sort of interesting extensions of Fisher and Verrecchia, but what we're really doing. Okay, so basically our intuition here is if you increase public scrutiny, you're going to get higher earnings response coefficients. This is not an assumption. This is a result of the model. And this is sort of consistent with this intuition. The more investors know, the greater the weight that they're going to be able to place on earnings and back out what the manager's intention is. By the same token, as public scrutiny increases, now this is an assumption, as public scrutiny increases by assumption, the cost of bias is also going to be. Now the question is, okay, benefits increasing, cost increasing. How the heck do you get this a U-shape from that? Well, let's think about that. Here's our benefits. Okay, we've got our concave benefits. And we have some convex costs, okay? And so now you can see where's the net the largest? Well, the largest net is in the middle. So if the largest net is in the middle, then that's where we would expect intuitively things to be most concentrated. That gets us an inverse U shape. And now I've taken some liberties in explaining the math. There is math in the paper in the appendix, and sort of condensed it down to a couple minutes. But that's sort of the general. Okay. All right. So we can plot in the model what the thing looks like for various cost functions. So we can make different assumptions. Is the cost function linear? Excuse me. Is it convex? Is it concave? And we establish conditions on what the cost function actually has to in terms of its convexity. Same thing for the investor's knowledge. Okay, so that's the theory. But what are we going to do now? Now that we've got this theory, we've got this U shape. How are we actually going to test it? Okay. So now we've got this unique prediction, really, in some sense. And the unique prediction is that we're talking about the shape of the relation, okay? A specific nonlinear shape. All right, so how are we going to test the shape of the relation, and how are we going to do that, with endogeneity and reverse causality and all these things in there? The identification police wants to know, how are we going to test the shape and controlling for all of this stuff, all right? So this is new kind of in accounting. There's a couple papers out there that hypothesize an inverse U shape. Fang et al. Is one. There's a paper by Sterling Huang at Singapore that looks at zombie boards, and they hypothesize an inverse U shape. So how are we going to test for this shape? So what we're going to do is we're actually not going to test a linear relation. We're going to test a nonlinear relation, estimate the shape, and then to explain the results, the alternative explanation or the endogeneity has to make a similar shape prediction. Now, that's possible, but it's really hard to come up with an alternative explanation. It's not as simple as, oh, well, when one increases, the other increases, and it's reverse causality. Because here the alternative has to actually explain why there exists a threshold around which the sign flips. I'm not saying it's not possible, just saying it's more difficult to explain than a normal linear relation. We're also going to validate the valuation monitoring channels. So we're going to show you that both channels are at work. And yes, as is de rigueur these days, we also have a quasi-natural experiment, if that's more your cup of tea. And so we've got a buffet of empirical results, and we've got a little bit of empirical results for everybody. So a couple of unique challenges that we're going to face because we're testing a functional form. We're going to want to maximize cross-sectional sampling variation, not minimize it. So oftentimes in empirical work, we think about minimizing cross-sectional variation to focus very narrowly on variation in our variable of interest. And that's a perfectly valid identification strategy. But here the issue comes that we need to get both sides of that inverse U. Okay? So the concern is there actually enough sampling variation to replicate the full theoretical shape? We don't know on the CRISP CompuStat or universe or whatever setting we have where in the reference distribution we're drawing from. Maybe we're only drawing on the left side of the threshold, in which case we'd find a positive relation. Maybe we're only drawing from the right side, in which case we'd find a negative distribution. Maybe that varies by countries. Some countries are on the right tail, other countries are on the left tail. And so to get unimodality, we actually need to maximize, we need to get the full actual sampling variation. So we need to get that full span on both sides. And that's why we need to actually maximize variation. So measures of scrutiny, shouldn't be anything controversial here. First principle component of analyst following, institutional following, and media coverage. Throw those things in and then use that measure of scrutiny and then standardize. So scrutiny. Measures of misreporting, restate due to intentional misreporting, so not restate due to errors. and bias the amount of the intentional restatement. Okay, so first channel, ERC. All right, so this is going to be standard ERC regression, price levels regression. Seen this, you know, I think they still teach these in PhD programs. Price on the left, earnings on the right, interact earnings with our scrutiny variable, returns, panel B, returns on the left, earnings on the right, scrutiny on the right, scrutiny interacted with. Surprise, nothing controversial here. This is more or less a replication of prior work, because prior work is established that scrutiny increases the monitoring channel. So monitoring channel, we're going to use this novel data on SEC investigations. I think last time one of my co-authors presented a paper at Miami. They presented a paper using SEC investigations. This is SEC investigation database we get from the SEC, and it's everyone that they've investigated since the year 2000 to 2017, regardless of whether they actually filed formal charges or not. So this is the let's call it the master list of who the SEC has looked into with an investigation. And again, not very different from an AER. We don't know what they've looked into. We just know that they looked into something at the firm, and they may or may not have filed charges. Okay, so there'll be many of these. These are non-public, and the public isn't necessarily going to be aware that the SEC is looking into the firm. If you're interested in the data, send me an email, and we're sharing the data publicly. Okay, so what we're going to do here is we're going to show you, just like with the ERC was increasing in scrutiny. We're going to show you that the likelihood that the SEC investigates you is also increasing in scrutiny. So what we see here is that across the quintiles of analysts, across the quintiles of media, across the quintiles of institutions, and across the quintiles of scrutiny, it's always increasing, monotonically increasing. In a linear regression, it also shows up as positive. And look, when we include a squared term, squared term doesn't load. So what this is telling us is that scrutiny is SEC investigations are increasing in scrutiny. And we showed that ERCs are increasing in scrutiny. Now let's look at the aggregation of these two channels in misreporting. The plots really tell the story at the bottom of the slide deck. The plots are basically plots of bias by quintile of each of our measures. We have similar results whether we do it by each of the individual measures of scrutiny, the aggregate measure, and whether we do it by bias or whether we do it by intentional restatement. In each case, the max value tends to be in either the third quintile or in the fourth quintile. So unlike what we saw for SEC scrutiny, so it's true, SEC is more likely to investigate you if you're scrutinized more. But it turns out that at that third quintile, beyond that, you're not actually more likely to restate or to actually get an SEC prosecution AER. Regression tests are a little bit different than what we saw because now we see that squared term load. So now scrutiny squared loads negatively, and that is what our test is of the inverse U-shape or the unimodal. That's what's different. That squared term matters for actual incidence of misreporting, but does not matter for probability of detection. Okay, some robustness. Throw in some additional variables used in prior work that looks at nonlinearities. Include nonlinear control variables. So take the Chow et al. Variables and square them. And what happens? And the answer is that the squaring the most variables does nothing. Whereas squared scrutiny does actually produce something. Regression tests. On the measure, as I said, a buffet of empirical results. You don't like our measures, maybe we use Edgar downloads instead as a measure of scrutiny. Similar results there. Alternative measures of misreporting. Okay, probability of restatement. Unscaled log of 1 plus the dollar bias. AAERs. And then this is also interesting. This is bias, so the amount of bias, conditional on actually restating. So it's conditional on restating due to intention. How much did you bias? And that amount is also unimodal. Then we do something that is unique to the paper. This was a learning experience for me, called multivariate adaptive regression spline. So not only are we predicting that the sign flips, we're predicting that there's a unique sign flip at a unique point in the relation. So basically there exists a unique threshold or a tau star below which the relation is positive, above which the relation is negative. What we're going to do is we're going to simultaneously estimate the slope of the relations on either side of the threshold, and we are also going to estimate the threshold itself in one maximum likelihood estimation. So that's the Mars estimation that we have. So this tells us that the estimation is there is one unique kink point, and below the kink point it's positive, and above the kink point it's negative. So this tells us that the sign is actually. All right, we also do it ad hoc just by centering it on the mean. Remember, I'm mean 0. So if you just hold to the mean, you get very similar. Finally, a shock. Okay, so if you're concerned about endogeneity or reverse causality, and I didn't convince you that testing functional form or that sign flips help rule that out economically, you want to see some sort of quasi-natural experiment. A couple of things to keep in mind before going down this path. First, we are not going to be interested in the average treatment effect, because the effect of the shock to scrutiny on a firm is going to vary depending on what side of the threshold the firm is on. So if the firm is on the left side of the threshold, below S star, an increase in scrutiny is going to increase misreporting. But if it's on the right side of the threshold, an increase in scrutiny is going to decrease misreporting. And so it may very well be that the average treatment effect would be 0. So interesting shock hasn't really been exploited by the accounting literature. I'm going to take like 2 more minutes because of the technical difficulty. In July of 2003, Form 4 reporting on Edgar became mandatory. So they didn't have to report Form 4s on Edgar before that. It's not just that the speed increased to 2 days, it's that before they were mailing Form 4 in. So Form 4 is the form that has all of the trades of officers and directors. So to verify this, you can go to Health South on Words or on Thomson Reuters, and you will see Health South Form 4s before 2003. But if you go to SEC Edgar's site, there are no Form 4s from Health South before 2003. Why is that? Well, Thomson was sending a physical person to the basement of the SEC daily to scan in all of the Form 4s that they were then providing to their clients. So only after July of 2003 was mandatory Form 4 or Form 4s required to be posted on Edgar. So that opens up a lot of managers to significant scrutiny by the public. Okay, so we got to change the sample, because we're back in the early 2000s. We're not going to have press release data from the early 2000s. We don't actually have restatement data from then. We're going to have to go switch to AERs. Okay, so we got a lot of changing dials here. We have to switch our research design because we're not testing for a squared trim anymore. We're basically going to be estimating an average treatment effect in a normal diff and diff, treated times post. Standard year industry pre-post design with controls. Average treatment effect insignificant, and it looks pretty much like we got some evidence of parallel trends. Nothing showed up. So in a traditional study at this point, we would maybe pull the plug because our quasi-natural experiment didn't tell us the average. Tells us the average treatment effect is 0. That's generally what people who do this sort of design are interested in. That's not a problem for us. Right? So this is, you start to sweat bullets when you're doing the data analysis because you run the quasi-natural experiment and you see, oh man, coefficient is 0. Right? But fortunately for us, we're not predicting an average treatment effect. All right, what we're predicting is heterogeneous effects. So now let's slice the sample by quintile of analysts, slice the sample by quintile of institutions, and then look to see within each quintile what the effects are. All right. So luckily for us, it came out that bottom quintile of analysts, so no analyst coverage, that shock increases misreporting. You're in the top quintile of analysts, the shock decreases misreporting. And that's same for institutions and for analysts. Now these are all marginal effects, all right? So you've got to add up some interaction terms to do the total effects. And we do that in the paper. And what we see is that in quintile 1 and quintile 2, positive effect, quintile 5 is negative, regardless of our. Okay, so I'll just wrap it up. It's a novel framework, 2 countervailing forces. You know, it's not really unique to public scrutiny. I mean, we framed the paper as about public scrutiny, but if you could think larger about limited attention, about other measures that might simultaneously increase the ERC, simultaneously increase the cost function, will get you something similar to this. And hopefully push people beyond linear relations. I think we've often focused too much on linear relations in the literature, as opposed to actually looking at the shape of the data, what the data is telling us, and focusing on cross-sectional variation, saying average treatments are interesting, but you know, what about non-average treatments? What about heterogeneous treatments in certain populations? That's all I have. Thank you very much for the opportunity.
Thank you very much, Dan. So now let's turn to the Q&A session. And we'll start probably with Fabrizio's question and then go back to John and Sundaresh.
Hey, Dan, can you hear me?
Can you identify yourself?
Yes, Fabrizio, how are you?
Fabrizio.
All right. Great presentation. Thanks for coming and presenting the paper. You actually had a general comment that you kind of touch upon in your last slide. That is, I mean, one way to look at the paper is to say, okay, if I take a Fisher and Verrecchia and I introduce a factor that affects both benefits and costs, then we know that at that point, you know, kind of all bets are off. That was the net effect will depend on the functional form of the benefit and cost, right? So in your graph, you know, you had the 2 curves, you know, with the gap between the 2 curves increasing in the middle, right? So the moment you accept the notion that the same factor affects both benefit and cost, clearly, you know, to predict the net effect, you need to impose some functional form, you know, so that seems to kind of drive the prediction. So in some sense, it's not really about public scrutiny, as you pointed out in your last slide. It's any factor that you assume to be affecting both benefit and cost. So in that sense, however, when you think about public scrutiny, one tends to want to know exactly what you mean by that, right? Because if I define public scrutiny in terms of, you know, investors' attention, you know, that would obviously affect a lot of the benefits in terms of ERC, much less the cost side, right? And I think as scrutiny on the cost side, you can think about, you know, the audit committee, like, you know, the paper that, the Kasky paper. So in some sense, there's going to be some factors within scrutiny that seem to affect only the evaluation part or only the cost of misreporting part. And then there's going to be probably something, you know, overlapping, which is what you capture. So for you to find that empirical result, it seems you're kind of saying that, you know, that overlap in scrutiny that is the same, you know, that affects both valuation and cost is so much large compared to factors that only affect cost or factors that only affect valuation that generates this prediction, which, you know, I mean, you find in the data, so that seems to be, but, you know, I was wondering, you know, how do you think about that? It's modeling and valuation overlap.
Yeah, so let's unpack that. There's a lot there. And, you know, I explained it at a very high level. I sort of glossed over a lot of more nuances. And so no surprise, the math is more nuanced than the intuition, right? So just some facts. It is not the case that simply because something affects benefits and affects costs, you know, increases benefits and increases costs, that you will necessarily get an inverse U-shape. So we derive some sufficient conditions on the shape of the cost and benefit that get us the inverse U-shape. So in most of my prior life, you know, I would say before this paper, I always thought that there had to be one competing, you know, one channel had to win. So when we typically write our papers, we say, oh, there's 2 reasons this would happen. On the one hand, it would increase because of this force. On the other hand, it would decrease because of this force. It's an empirical question which one dominates, right? So there we typically say it could be positive, could be negative. Oh, look, it turns out that it's positive, consistent with this force dominating, right? That's so just because there are 2 forces and they're going in opposite direction doesn't imply that you'll get a U-shape, an inverse U-shape. Right? So, you know, there is some reliance on a functional form of the cost function and of the ERC that we derive, and the data sort of supports that functional form. So I don't want to say that any benefit and any cost will get you this. It has to be of that functional form. In terms of any factor, I mean, the math, so let's talk about the math as opposed to the empirics. You know, when you have a mathematical model, you know, it's always a question of what you call X. Is X earnings? Is it revenue? Is it cash flow? And so for me, when we were motivating this, I thought of naturally, you know, eyeballs on the financial statement as motivating both the value relevance channel and eyeballs as motivating a monitoring or a detection channel. But, you know, I take the point, there could be something like an audit committee that might affect monitoring, but might not affect evaluation, or something that might affect evaluation that would not affect, you know, monitoring. And there, you know, you would not expect to get the inverse U. I guess I view this as more like, if you look at your data and you see that there is an inverse U shape in your data, that is not necessarily a problem that you should sweep under the rug when writing a paper or conducting an analysis. What it means is that maybe, you know, think a little bit harder about how the costs and benefits interact, as opposed to one force always wins out over the other force. If that makes sense.
Yeah, no, that makes sense. I mean, that was exactly the point. It is, if you start from the empirical result, and then you say, okay, I want to try to understand how can emerge in theory, because it seems to be counter the conventional wisdom of misreporting, then I can totally see that, you know. But ex ante, when you build that model, I mean, when Fisher and Vecchia do the model, you know, they try to separate constructs, right? So in some sense, they don't want the same factor affecting cost and benefits directly, right? Because
I mean,
the point is to get it different. So the cost of misreporting should be a separate construct from the drivers of ERC. Now, empirically, it may happen when you look at measure of public scrutiny, there's some overlap, yeah, and you know, but yeah, I take your point. Yeah, I understand. Yeah.
Thank you. So next question is from John.
Aloha, Dan. I like your house, and I also like your whiteboard. I'm thinking about getting a whiteboard at home so that I can get more respect from my kids. So my first question is, how do you think about the role of corporate governance, like board of directors and auditors? How does this corporate governance interact with public scrutiny?
Yeah, so that's a good question. I actually, if I was to, you know, extend the paper further, what I would kind of do is, and many people are going to find this surprising, but this is what the scientific process is. I would look sort of at the shape in the data of, you know, a measure between corporate governance and misreporting or of public scrutiny. And I would look to see, is it U-shaped? Is it linear? You know, what do I actually see in the data? And then think about whether that's consistent with what we have, you know, whether that could be forced potentially to be consistent with what we have here, right? So one story would be, you know, we know, I think, that corporate governance increases the ERC. I think that's a result, but suppose that's a result, take it as, sure, that must have been done in the 90s or, you know, in early 2000s. So then if we know that corporate governance increases the ERC, does corporate governance increase the cost of misreporting? Well, potentially, because the Caskey paper suggests in the presence of an audit committee that the audit committee has, you know, some sense of better ability to detect and penalize the manager before the report gets publicly disclosed. And so one could think about building in governance into the model by operationalizing it as some sort of internal committee that basically serves as a check on the CEO before it gets reported. And you could also, you know, as Fabrizio said, you could also think about potentially building that into a cost function and into the information that the investors have. So that's how you could, I don't want to say force governance in, but that's how governance might show up in this framework, right? You could potentially expect it to.
My second question is, let's say focus on the role of media. When there's a lot of scandals, media begin to pay attention. So when there's more scandals, there's an increase in media coverage. When there's an increase in media coverage, maybe firms get scared. There's a decrease in scandals. So I think it could be, in terms of unimodal, it can be bimodal. So right.
I see. I see.
Yeah.
So something to there's an additional paper here. It's related to a paper that Lucy Hale, Claire Wang, and Ahmed Tahoun had at a JAR conference, and it was whether the media leads or lags the regulators.
Okay. Oh, yeah.
So notice that we have in our paper, we have SEC investigation in the future, T+1, but we have the media coverage in period T. So what we're saying is that the media is sort of the scrutiny is coming before, right? So one can imagine a world in which the SEC looks at the Wall Street Journal headline, is Tesla a fraud? And then someone at the SEC says, maybe I should look into that. And then we open up an investigation. So there are lots of additional papers to write here about whether the SEC's investigations, are lagging the media or lagging short seller reports. What's informing their investigation function? For us, we've taken that as given, and we've just said, look, all we know is that the media tends to come before the actual investigation. But there's a much richer analysis, I think, than the single table that we have in the paper.
My third question is there kind of like a size effect? Because I think the large firms are getting more attention, more media coverage, more analyst following, and more institutional ownership. Because, for example, if you look at the index fund, some of the pension fund can only invest in S&P 500 firms.
Right.
So is it kind of like a size effect?
Yeah, so I mean, it's definitely the case. We have to control for size, just to say that we have something unique to the literature. But one could imagine a path model through which size affects misreporting through scrutiny, right? So it's always difficult, what constitutes a good control versus what constitutes a bad control. Now, in this case, we put size in because, size, if we included size and the results disappeared, it's kind of hard to get that paper through the process. But, need to spend some thought on why size might actually matter. One channel is scrutiny. We're finding scrutiny matters also holding size fixed. The other institutional detail I would point out is that if you were to break the firms into size deciles, right, what you find is that the SEC, 20% of SEC investigations are in that top size decile. So the SEC is definitely going after larger firms disproportionately relative to smaller and medium-sized firms. That's just a stylized empirical fact, and we can interpret that and spin stories about that, but that's kind of the fact out there.
Thank you.
All right, thank you. So the next question is from Sundaresh.
Hey, Dan, this is Sundaresh. How are you?
I'm doing well. How are you?
Good. Interesting paper. I kind of like the Q1 through Q4. The Q5 kind of seems like, conventional wisdom almost. I was just curious about the distribution of, things like profitability on Q1 through Q4. Especially if you think about quintile 1, these are firms nobody cares about. Maybe they have no reason to wake up in the morning kind of firms, right? And so earnings management for these guys is almost impossible, right? We're just so bad. What are we managing? So it's not that, I'm afraid of getting caught or I'm going to get some kind of benefit out of this thing. It's just, I'm so far out that, there's just no reason to manage earnings.
So let me see if I can recast that. So you're basically, I think, hypothesizing that there's some constraint on their ability to manipulate earnings. So even if they wanted to, they couldn't because they're, some unique firm characteristic, like they're just awful. The firm is awfully performing. So for that type of firm, there's no ability to manipulate earnings, even if they could. Yeah. So that I hadn't thought about that before. It's kind of outside of the framework, but I take the point that we need to think carefully about that, because if the constraints to manage earnings happen to vary across the quintiles in a unimodal way, that would be a problem for us, right? So we need to say that somehow quintile 5 firms are somehow more constrained than quintile 4 or than quintile 3. or that those firms are less constrained than quintile 1. But yeah, I take the point that that's maybe something we should give some more thought to.
Thank you.
All right. So actually, I have the next question. Basically, my question is more conceptual. Something that I guess also traces in Fabrizio's and John's comments is, what is exactly public scrutiny in a setting, right? Because on the one hand, you have proxies for something I would call information environment, more analyst. And then you have media attention, which is maybe related to, some, bad press, reputation sort of, right? Sort of articles or, scandals, something like this. And these may technically have different effects on your outcome variables, right? So how exactly, what do you think about public scrutiny in your setting? What is that you're trying to measure?
I'll be honest with you, coming up with names for this paper were difficult. Like that's probably why I'm not a theorist. Like if you think about, for some reason in accounting, we seem to be okay with the word like information asymmetry and assigning certain variables like analyst coverage, bid-ask spread, accrual, size, book to market, all of those things to measure information asymmetry. We seem to be like okay with the word information environment, right? What is information environment? Well, these things are all information environment. Maybe we throw in voluntary disclosure and mandatory disclosure in there. And so, coming up with a set of variables that we think fit, and then coming up with an overall basket on which to name those variables, it's a bit of I admit it's a bit of a labeling game. That's one reason why to be honest with you, why we showed the results hold for each of the proxies individually, right? So it holds for analysts, it holds for institutions, it holds for media. And what we were trying to say there is that all of those things have one thing in common. And that one thing in common means there's more eyeballs on the firm, right?
So like attention, right? Basically, you're talking about attention.
Correct, attention, right? So we could call it, attention. And that would, to me, that, maybe we should relabel it. But that's kind of what we're trying to, to drive for. I mean, an earlier version of this paper used the term information quality and information environment, and that didn't go so well because, the firm has that within their control. It includes mandatory disclosure, it includes fog index, it includes accruals quality, it includes all of these other things. And so we didn't want to go down, like it's almost too broad. So we wanted something a little bit narrower than information environment and information asymmetry, but we didn't want to make the paper about the proxies. Okay, so this is the one thing I tell the PhD students: make the paper about the constructs, not about the proxies.
Yeah, exactly. And basically, the reason I just gave this comment, right? As I was reading the paper, I had a very different thing in mind, and then I don't think you can explain this in the paper until you get to say, well, we measure through these variables. That's when, okay, that's what you're doing. Before that, you don't kind of define what that is. So maybe just clarify this would be nice. Clarify this in the paper.
Well, I should also mention that Delphine is one that's called my co-author, and she's taking notes. So if you don't see me writing,
thank you. All right, so let's get to the next question. We have a question from Farouk.
Hi, Dan. Thank you very much. I like the story and also the novelty in that. So I think it's a great paper to sort of read again, perhaps from my perspective. I get the idea of unimodality. Yes, finally I do that. But I'm not sure whether the least scrutinized is the least manipulative. The reason being that I don't get the story, because I think a lot of those companies on the left side, it's a very nice and tidy U shape, inverted U shape. But my worry is then that are we sort of suggesting that they have no reasons to manipulate or very low reasons? Because I think logically it suggests otherwise, because I would think perhaps the company really is struggling at the moment will have more reasons to manipulate, and also like debt covenants, for example, right? And a lot of theory in my mind, it does sort of suggest otherwise. How do you explain that point? That's the first part of the question. Second part is simply, I think, about how do you classify unintentional and intentional misrepresentation, and how do you see those two things? Thank you.
Okay, all right, good. All right, so the first one is with any theory paper, we have to, it's interesting working with theorists. I rather enjoy it. In an empirical world, when we try and control something by including a variable in the regression, we say, oh, we've controlled for firm size, we've controlled for. Theorists control for things by assuming it doesn't exist, by sort of saying the only thing that exists in this world is valuation. And so this is a model about valuation. So stewardship, debt covenants, all of that outside the context, right? So it's the benefits that we're talking about are solely equity market price benefits. And so the assumption here is we're not saying the other stuff doesn't exist. We're just saying in the model, that's what the driving force is. So when you think about, back to your comment about are the less scrutinized, they would actually have more reason to manipulate. From an equity price perspective, if they're less scrutinized, then the equity market doesn't respond in the same elastic fashion or with the same elasticity that it does to a firm that's highly scrutinized, right? So think of it like a PE multiple, right? If I have a PE multiple of 2, I manipulate earnings by $1, I get $2. If I have a PE multiple of 1,000, I manipulate earnings by $1, I get $1,000. So we're basically relying on the link between scrutiny and, in some sense, market PE, or the elasticity of reaction to earnings. But I take the point that,
I would still like to see some controls, I think, Dan. I think just to make sure that that's my personal view.
Yeah, no, I take the point. I mean, you're right. Those guys in the low scrutiny, they still have debt covenants to worry about, and
Yes.
Maybe this
and even T-1, for example, what's been nice, low, so small loss, for example, would be reason to go into the right side of the 0 point.
Small loss. Go on with small loss.
If it's a little deficit, a little on the left side of the 0, for example, so that could be benchmark
Right.
sort of to achieve, and
Right.
that's probably more relevant than a lot of the controls, I think.
Right. No, that is certainly true.
Yeah. Okay. Thanks.
So then the second point was intentional versus unintentional. So
Yeah.
So 4 variables: SEC investigations. We don't kind of know. That's a black box to us. Intentional restatement, amount of intentional restatement, and then AAER. AAER is, the end game of the SEC investigation. And then, so the middle, the bias and the intentional and unintentional restatement, we're going to rely on audit analytics there, right? So audit analytics has a classification. Is it fraud? Is it misrepresentation? Or does the firm say, oh, this was a clerical error? Or, so it's the stated reason as classified by audit analytics. So we're not going to apply our judgment there. So if audit analytics is screwed up, then we'll be screwed up. I will say this, it holds exactly if you don't make that distinction. But we wanted to be precise because in the model, it is intentional as opposed to clerical error. And so that's why empirically we used intentional, but it's even stronger if we pull in all restatements.
Thank you.
Thank you very much. The next question is from Sichi.
Hi, Professor Taylor. I really enjoyed reading your paper. I think it has a great contribution because it highlights the limited about current empirical research about the misreporting. I have a quick question. Is that possible to find the warning point where the mendacity is high? Like, for example, regulators, they may pay more attention to what kind of companies, like how many analysts are following this company, like how many institutional owners, is there an within the range, like the leverage, the ROA or sales growth, something like that. So it may have more contributions.
So is your question, you want us to reveal what the numbers are for each of the quintiles for analysts and institutions, or is it more, you want to see some firm characteristics for those?
When I read the conclusions, I didn't see maybe what kind of companies they may have the mendacity is pretty high. So what do you think about that?
Yeah, I mean, one, I like to have regulatory implications. I think often my regulatory implications get watered down in the process. But I do think that there are regulatory implications here. And I think the main one comes from the fact that the investigation function is inverse U, or it's linear or increasing always, but the actual incidence of fraud is inverse U-shaped.
Okay.
So that, to me, while maybe there's a complicated model out there that would explain why that would be the case, if I was the SEC and I was trying to use efficient use of resources, I may not actually want to concentrate as much as I do on that highest scrutiny, largest set of firms. You can tell a story that, maybe there's a revolving door, it increases career incentives to, put some of the very famous people's head on a platter. So there are reasons for that. But, if I was to tell standard setters, I would say concentrate the enforcement where the data suggests the fraud is actually occurring.
Thank you so much.
Thank you. So I think will be our last set of questions will be from Francine.
I don't have a specific question, but more just a series of observations.
Okay.
I think your idea that is the SEC lagging media, or is media lagging the SEC? I think that's really an interesting area for someone to continue to explore. But your data is focused on open investigations, and I think if someone had enforcement data and was looking at that, they'd get a different answer.
Absolutely.
I also like Siki's question, and what I was hearing was that she's looking for an inflection point. She's looking for, where do you start, on that U-shaped curve? Where is it, sort of flipping? Where is it hitting the plateau? Where is it flipping down? And is there an indicator, a flag? Is there something that signals the inflection point?
Yes. Yeah. Okay. So yes, there is, and we can certainly reveal, the threshold, the number, like 11 analysts or whatever it is in the paper.
All right, thank you. Actually, I think we still have time for one more question. We'll ask Rosie to ask her question.
Hi, Dan.
Hello, Rosie.
Hi. It's a great paper. So I have a probably minor question. So I'm thinking about the valuation channel. So is it possible that the reason misreporting increases in public scrutiny is because managers feel pressure to beat market expectation or look good to the investors under the investor or media spotlight, not because they feel that they can claim more private benefit in a more transparent information environment? Yeah. Yeah, so there's no, that's entirely possible. I would say that would be an additional channel, would be some sort of reputation effect, right? Right.
So the model is solely price-based, right? So one could imagine that a CEO, even without, in our theoretical hypothetical world, a CEO, even without any equity incentives, but with scrutiny, would still potentially be motivated to misreport because of the, the reputation. Right. They secure another job, they want to be famous, and that I think that definitely could be going on in the data. Something that we should think about. But
yeah, possibly you could discuss that in the paper.
Yeah, we don't model that in the model. I will also say, if you have any other questions that we couldn't get to today, you can send me an email. I'm happy to take email questions and give some responses, and obviously great to get such comments and suggestions.
All right, thank you.
So I guess we'll end here. Dan, thank you very much for presenting your work. It's been a pleasure. Everybody else, thank you for participating, asking questions. As I mentioned, if you have any comments or questions, please email Dan and his co-authors. I'm sure they will respect.
Don't email Ro, email me.
All right, email Dan. So happy Friday and have a nice weekend. Thank you, guys.
Thanks, everybody.
Take care. Thank you.